Hello and welcome back to the Deep Dive. It is January 28th, 2026. If you've had your coffee and scanned the financial headlines this morning, there is a lot of noise out there.
Yeah.
But one signal is coming through way, way louder than the rest. We are talking about LendingClub.
It is definitely the story of the morning. They just dropped an earnings report and a strategic update that is, well, turning a lot of heads in the fintech world. And honestly, it's about time we took a serious look at what's going on over there.
Absolutely. And we aren't just talking about a good quarter where they beat expectations by a penny or something.
Oh.
We're looking at a company claiming one of the best years in its history. Now, for the cynics in the audience, and, I count myself among them sometimes, claims like that usually trigger my alarm bells.
Sure, corporate BR can spin almost anything.
But we have the documents right here. We've got the earnings call transcript, the investor deck, the raw data. And our mission today is to figure out, is this real?
Spoiler alert. The numbers suggest it's very real. But for me, what makes this so interesting isn't just the profit or the stock price. It's the how. This is a case study in executing a massive strategic pivot without, breaking the whole business.
Exactly. And think about the context here. We've seen so many fintechs struggle or even fold in the last couple of years. The interest rate environment has just been brutal. And yet here is LendingClub reporting a 40% jump in loan originations in a single quarter. While everyone else is treading water, they seem to be finding a completely new gear. So we need to unpack that. How do you grow that aggressively right now?
And maybe more importantly, is that growth healthy? Or is it just a sugar rush that's going to lead to a crash later? That's the real question investors should be asking.
Right. So let's start with the immediate reaction to the numbers. I was looking at the originations. $2.6 billion in the last quarter alone.
Yeah.
That's up 40% year over year. That's a headline number that just screams growth.
It is. But I'm allergic to vanity metrics. Volume is vanity. Profit is sanity.
Right.
Anyone can lend money if they aren't worried about getting it back. So I went straight to the efficiency metrics. The number that actually tells the story here is ROTCE, return on tangible common equity.
Okay, let's pause and really unpack that. We hear ROE, return on equity, all the time. Why focus on ROTCE here?
Right.
What is it telling us?
Sure. So equity is just the book value of the company. But tangible equity, it strips out the fluff. It takes out goodwill, intangible assets, things you can't really sell if it all goes wrong.
So it's the hard assets.
Exactly. ROTCE basically measures how well a bank is using the actual hard capital shareholders gave them to generate cash. It's like the engine's efficiency gauge.
The pure performance metric.
Exactly. And LendingClub's ROTCE hit nearly 12% this quarter.
And for context, where was it before? Is that a big jump?
It's effectively a threefold increase.
Yeah.
That is a massive, massive jump in efficiency. It tells us they aren't just originating more loans, they're extracting way more profit from every dollar of capital they deploy.
That's a crucial distinction. It's easy to grow originations if you just lower your standards, spend a fortune on marketing, and shovel money out the door.
Right.
It's incredibly hard to grow by 40% and triple your efficiency at the same time.
Precisely. That's the magic trick. And if you look at their earnings per share, their EPS, it more than doubled year over year. So the bottom line proves the model is working. But the question remains, where's that safety coming from? How are they lending more money without taking on a ton of bad risk?
That leads us right into our first big section, the secret sauce. We've got annual originations growing 33% to nearly $10 billion. That's a lot of cash.
A lot of cash.
And the source material leans heavily on one word to explain how they manage this: data.
It does. And I know, data is the most overused buzzword in our industry, maybe in every industry.
Oh, for sure. Every startup with a spreadsheet claims they have a data advantage.
Right. We have an AI. We have proprietary algorithms. We hear it every day. Why is this different?
Yeah, what's different here?
It's about scale and, crucially, vintage. LendingClub isn't new. They've been around since 2007. They cite over 150 billion data points. That isn't just volume, it's history. Think about what we've been through since 2007.
Oh, man. The 2008 financial crisis, the long bull run, the COVID pandemic, stimulus checks, the inflation spike of 2024.
Exactly. They have data on how borrowers behave through every single one of those unique economic stress tests. Most fintechs that popped up in, say, 2020 only know how borrowers behave when rates are at zero. LendingClub has the full historical map.
So when they're underwriting a loan today, they're not just guessing how a borrower might react to stress. They have a historical precedent.
They're not using a compass, they're using a high-def GPS. And the report puts a specific number on this. They claim their credit performance is 40 to 50% better than their competitive set.
Hold on, I want to make sure I heard that right. 50% better. That is a massive delta.
It's huge.
Usually in lending, you see like a 5 or maybe a 10% edge. Someone is slightly better at picking winners.
Yeah.
But 50%.
It is a staggering margin. That's not an edge, that's a moat. And that margin is what lets them price loans competitively while still making a profit. They explicitly state that even as they ramped up to that $2.6 billion in originations, the repayment behavior stayed stable. They didn't have to loosen the credit box to get the growth.
Which is the classic trap, right? You run out of prime borrowers, so you start lending to subprime just to keep the chart moving up and to the right.
And then 2 years later, everything blows up.
Yeah.
And they completely avoided that. They credit strict management and advanced underwriting, but really it's that 150 billion point library. You can't just buy that data. You have to live through it.
Okay, so the underwriting engine is solid. They know who to lend to. But a lending business has two sides. You need borrowers, but you also need the money to lend. We need to talk about capital. Who is funding these $10 billion in loans?
This is where we see the strategic pivot that really saved them in 2025. If you recall, a couple of years ago, there was a capital crunch. Traditional banks got scared and pulled back from buying consumer loans.
Right. The regional banking crisis, liquidity fears, everyone tightened their belts.
Exactly. If LendingClub had stayed reliant on just selling loans to regional banks, we might be having a very different, much sadder conversation today.
Yeah.
But they pivoted. They identified a new buyer. Insurance companies.
Insurance companies. I mean, on the surface, that seems like a totally different beast than a bank. Why are they a good fit?
It's all about liability matching. Insurance companies, think life insurers, annuity providers, they sit on these massive piles of cash.
Right.
But they need to hold it for 20 or 30 years to pay out future claims. They need yield, they need to beat inflation, but they need the investment to be relatively safe and predictable.
But they can't just buy raw loans off a marketplace, can they? An insurer doesn't want to service a $15,000 loan to some guy in Ohio. They just aren't set up for that.
Correct. Operationally and from a regulatory view, they can't touch raw whole loans. It's too messy. So LendingClub had to engineer a product for them. The sources call it a rated structured certificate.
That sounds incredibly technical. Let's break that down. No jargon. What is that?
Think of it as a wrapper or a translation layer. LendingClub takes a pool of, say, 1,000 loans. They bundle them together. Then they get a credit rating agency to analyze that bundle and stamp a grade on it, AAA, AA, whatever. Suddenly, it's not a pile of loans anymore.
It's a security. It's a bond.
Exactly. They translated the asset into a language the insurance companies speak. They turned loans into investment-grade securities.
Perfectly put. They tailored the product to fit the wallet of the buyer.
And you can see the results in the revenue. Platform revenue was up 36% because the sale prices for these loans have recovered. They created a product that investors are, fighting to buy.
And looking at the partnerships, this is attracting some heavy hitters. The report mentions BlackRock and Blue Owl. But there's a new term here from Q4 that stood out. A forward flow agreement with a major U.S. insurer.
Ah, yes. This is significant. A forward flow is the holy grail of stability for a lender.
How does that differ from just selling a bundle of loans when you have them ready?
Well, usually you originate loans and then you hope you can sell them. You're exposed to the market spot price. Maybe it's good today, maybe it's bad tomorrow.
Right, it's uncertain.
With a forward flow agreement, the investor signs a contract saying, I agree to buy X amount of loans every single month at a pre-agreed price formula as long as they meet these specific credit criteria.
So it removes the uncertainty. You know the buyer's there before you even make the loan.
Exactly. It turns the business from a trading floor into a factory line. You have guaranteed volume, and you don't get BlackRock or major insurers signing these deals unless they deeply, deeply trust your data.
So they have the bank status for the regulatory seal of approval and the data history for the performance assurance. It's a powerful combo.
And that brings us to the entity itself. They call themselves a digital marketplace bank.
For a long time, I honestly thought that was just marketing fluff.
Yeah, we're not a bank, we're a tech company. We've heard that pitch a million times.
A million times. But looking at these 2026 numbers, it's actually their operational engine. They aren't just a fintech, and they aren't just a dusty old branch bank.
They have the charter. They bought Radius Bank a few years back.
Which was a controversial move at the time. People ask, why do you want the regulatory headache of being a bank?
And the answer is deposits.
Cheap funding. Net interest income is up 14%. That's the money they make from holding loans on their own balance sheet, funded by their own customer deposits. When rates are high, having your own supply of low-cost funding is a massive advantage over a fintech that has to borrow money from Wall Street.
So they combine the speed of the fintech, the app, the instant approval, with the balance sheet efficiency of a bank. It's a hybrid model. And looking at the landscape right now, it seems to be the only model that's really thriving. Pure fintechs are starving for capital, and traditional banks are struggling with tech. LendingClub is sitting right in the sweet spot.
You know, I want to pivot to something that I found genuinely surprising in this report. We've talked about the how and the who of the money, but let's talk about the who on the customer side, the actual borrower.
Yeah. This is the behavioral economics part of the story, and it's arguably the most impressive piece.
Usually we think of personal loans as transactional. I have credit card debt, I get a loan from LendingClub, I pay off the cards, I pay off the loan, and I hope I never talk to them again.
Right. Thanks for the lifeline. Goodbye.
Yeah.
That's the traditional model. You don't want a relationship with your debt collector.
Exactly. But they are seeing something totally different. Let's talk about Level Up Savings.
This is a product designed to flip that script. It rewards customers for good saving habits. It's seeing double-digit growth. But the statistic that jumped out at me, and I had to double-check this because it seemed too high, is the average balance.
It's wild. Customers who pay off their loans are now using this account to build a safety net. And the average balance is over $15,000.
Think about who these people are. These are prime borrowers, mostly high earners, who just got a bit overextended on liquidity. Maybe they had a medical bill, a wedding, whatever. Once they fix the debt problem with the loan, they have the capacity to save.
And LendingClub is capturing that. They aren't letting that money walk out the door to Chase or Wells Fargo.
It changes the narrative entirely. It's not predatory lending or debt trapping. It's financial graduation. You enter the ecosystem as a borrower, you fix your balance sheet, and you stay as a saver.
And the engagement data supports this. The report says Level Up Savings users log in 20 to 70% more often than traditional savings users. They're engaged.
And then look at the checking product. Level Up Checking. 60% of their new checking accounts are coming from people who started out with a personal loan.
That is a staggering cross-sell rate. Most banks would kill for that. Usually, cross-selling banking products is like pulling teeth.
And 84% of those people say they intend to use LendingClub for a loan again if they need one. This is the flywheel effect.
Explain the flywheel effect in this context. Why does that matter so much to the business?
Sure. In fintech, your biggest line item is customer acquisition cost CAC. You spend hundreds of dollars on Google ads or mailers to find one borrower. If that borrower leaves after one loan, you have to spend that money all over again to find a new one.
But if they stay,
If the borrower stays, opens a checking account, keeps 15 grand in savings, your cost to acquire them for the next product is effectively zero.
and the deposits they hold provide the cheap capital to lend to the next person.
Exactly. It becomes a self-reinforcing loop. The report calls it a designed engagement model, and frankly, it is working perfectly. They're turning one-time users into lifetime members.
So they have the data, the funding stability, and a loyal customer base that's actually building wealth. The ship is steady. So where do they go next? The 2026 Outlook mentions a new frontier.
Well, if you are a homeowner, you know the pain of trying to finance a renovation.
Oh, don't remind me. It's either a high-interest credit card or a complicated HELOZ process where you have to get your house appraised. It's a mess.
A total mess, and it's a $500 billion market. LendingClub is betting big on solving that. They are entering the home improvement market.
The report says they've already acquired the tech code and hired the leadership team. Launch is mid-year 2026.
It makes total strategic sense. Think about that customer we just discussed. They have a $15,000 savings balance. They trust LendingClub. They probably own a home. Why wouldn't they trust LendingClub to finance a new roof or a kitchen remodel?
It feels like a natural extension. You help me fix my balance sheet, now help me fix my house.
And because they're a bank, they can hold those loans. Because they're a fintech, they can probably approve the contractor and the loan in minutes, not weeks. They aren't just dipping a toe in. They've signed their first retail partnership already.
And interestingly, the transcript mentions they're getting inbound interest from other partners, so retailers and contractors are coming to them.
Which suggests the market is hungry for a better solution. If they can crack home improvement the way they cracked personal loans, that is a massive growth driver for them. It diversifies them away from just being a personal loan shop.
And to wrap a bow on all this expansion savings, checking, home improvement, They are planning a rebrand later this year.
Which is long overdue, in my opinion. The name LendingClub is great heritage. It was perfect for 2010. But today, it's a bit limiting. It just says, we lend money.
It sounds like a place you go when you're in trouble, not where you keep your life savings or do your daily banking.
Exactly. If they want to be the primary financial hub for these high earners, they need a brand that reflects that, a brand that says wealth or banking, not just debt. A rebrand signals to the market and to customers that this is a new era.
Before we wrap up, we should probably touch on the governance. There are some changes at the very top, inside the boardroom.
Yes. Hans Morris is leaving the board in March.
And he's been a fixture there for a long time.
13 years. That is a lifetime in fintech years. He went from being an early investor to the chair. He saw the company through the IPO, the crisis years, the bank acquisition, and now this successful pivot. It really is the end of an era for them.
But the incoming chair, Tim Mayopoulos, he isn't exactly a rookie.
Not at all. He's been on the board for nearly a decade. He has deep experience in both traditional banking and fintech. This isn't a shakeup. It's a passing of the torch. It signals stability to Wall Street. It tells investors the strategy is working and we're sticking to it.
So let's bring this all back home. We started this deep dive by asking how LendingClub achieved that 40% growth and tripled their efficiency in such a tough market.
And I think we've found the answer. It's not magic. It's a combination of 5 specific competitive advantages that they've built over the last decade.
Let's recap them for the listener. Number 1.
Data. That 150 billion data points giving them a massive underwriting edge. That 50% better credit performance is the foundation holding the whole thing up.
Number 2.
High-value products. Specifically, integrating savings and checking to turn a transaction into a lifetime membership. They're capturing the full financial life of their customer.
Number 3.
User experience. The retention rates speak for themselves. People actually like using the platform, which is, rare in banking.
Number 4.
Agile technology. The ability to just plug in new verticals like home improvement quickly because they own their tech stack. They don't have to wait for legacy systems to catch up.
And number 5.
The hybrid business model. That digital marketplace bank, combining the speed of tech with the cost efficiency of a bank charter.
It's a compelling package. It really feels like the company has grown up. They aren't the scrappy disruptor anymore. They're becoming a pillar.
They have. And it raises a really provocative question for everyone listening and, frankly, for the entire industry.
What's that?
LendingClub has proven that a fintech can become a bank and thrive by acting like both. But as they move into home improvement and rebrand later this year, will consumers stop seeing them as just a lender and start seeing them as their primary financial hub?
That is the big question. Can you cross that chasm from being a utility to being a relationship?
The line between tech company and your bank is officially blurred. And if I'm a traditional bank CEO looking at these numbers, the retention, the cross-sell, the efficiency, I'm getting a little nervous. They are eating into the most profitable segment of customers, the prime earners. And they're doing it with a cost structure that traditional banks just can't match.
A little nervous indeed. Well, we will certainly be watching for that rebrand later this year. It sounds like 2026 is going to be a fascinating year for them.
Absolutely. It's one to watch.
That's all for today's deep dive into LendingClub. Keep learning, stay curious, and we'll catch you on the next one.